So um, it is capital, this one right here, retained earnings, and other comprehensive income. And remember, we defined other comprehensive income. We talked about other comprehensive income. We were talking about available for sale securities. These are activities that impact the company's equity, but they do not get recorded in the company's income statement. So you guys remember there's 4 basic financial statements. Right? The balance sheet, which you spent the most time talking about. There's the income statement, which is your revenues, expenses, your net income, or revenues, expenses, gains and losses, and your net income. You have the statement of cash flow, which you haven't talked about at all. And then we have the statement of stockholders' equity or statement of retained earnings. So this is an example of Apple's statement of retained earnings. And if you recall, I said the statement of retained earnings or statement of, if we talk about the statement of retained earnings, it would be this column right here, right? And I said it had 4 components. It had the beginning balance, which is this number here, plus net income, $59 billion, minus dividends paid, this $13.7 billion that was paid last year. There's also things like repurchase of common stock. So what this is telling you is that what is this? This is 2018. So 2 years ago, Apple repurchased $73 billion of their own stock. If we were to look at the entire statement of stockholders' equity, which shows 3 years of activity, so you have, this would show 15 to 16, 2015 to 2016, 2016 to 2017, 2017 to 2018, you would see that they've been purchasing about 60 to 70 billion dollars of their stock every year in each of those 3 years. Now, let's just pause for a second and think about that. Why would a company like Apple want to purchase back its own stock? They're buying stock from shareholders like you and I. Why would they want to buy back?
Have
stock?
Less people with controlling interest in their company?
Yes. Right? So there's something that they know, and I don't know what it is, but there's something that they know that says, wait a second, if they're willing to sell our shares in the marketplace for $190, $150, whatever it's trading at, that's a really good deal. Let's buy it back ourselves. Right? So when you see companies purchasing back their own stock, that could be an indicator that they're looking to make some big moves. And as we saw, as we've been looking at Apple's financial statements, they also are flushed with cash, right? So they have to figure out, what do we do with all this cash?
Could they be buying back their stock because they have so much cash available? So maybe that's like their plan is to, build up a lot of cash and then buy their shares back and then make a big move after using that still excess cash that they have. So the shareholders have less control of the company.
Yeah. That's spot on, Andrew. Now, what that move is, we don't know. But that's
a car.
That's the Apple car. Could be.
My dad was working.
feasible.
My dad was working for Apple like 2 or 3 years ago on like some top secret stuff, and my dad's like really big into cars, and so he was never able to tell us like what he was working on, but we all speculated that it was some form of a vehicle. Don't really know all the details, but but then the project lost funding, so he wasn't working on that project anymore.
I thought you were giving us a stock tip, but okay, never mind.
Well, I mean, it was a while. It was definitely positive speculation for a while, and there was optimism. Oh, is there going to be an Apple car? But I mean, obviously that takes years and years in the make. But yeah, he was working on it for a while. I mean, I wouldn't doubt that they're still working on something like that. You know what I mean?
Yeah. All right. Time will reveal.
Yeah.
So this is just a summary of how corporations are set up. So when we talk about generally accepted accounting principles, right, and we're talking about Securities and Exchange Commission, the SEC, right? So any company that's publicly traded, right? So their financial statements are available to the public. They're registered with the SEC. They're structured as a corporation. Okay? And the way a corporation works is it's owned. So first of all, let me step back. A corporation is its own separate entity, right? So in other words, it has to pay its taxes. It's almost like a citizen, except it doesn't have voting rights, but it's its own separate person. Okay? It separates itself from the owners of the company. So when you purchase stock and you become a stockholder, right? We all went and bought one share of Apple. That would make us part owner of that company. So when we say stockholders, we're referring to the owners of the company. So the owners of the companies are the ones that get to elect the board of directors. And the board of directors are the ones that are responsible for setting the strategic direction of the company, right? They're the ones saying, let's expand into this international country. Let's contract this particular service. Let's discontinue this particular product, right? They're making those decisions. The board of directors is then going to elect a CEO, right? So that man or woman is the person responsible for executing the strategy, right? So they're running the company. Now, in some instances, the CEO could also be the chairperson of the board, okay? But that doesn't necessarily have to be the case. The CEO doesn't even necessarily have to be on the board. Okay? The board is separate, and then they have management. Okay? So the board is representing the owners, and they hire management. The CEO then hires a chief operating officer, who's then going to hire all the vice presidents and the CFO, chief financial officer, and then each one of those vice presidents or chief officers will then hire their team, right? So if we're talking about the chief financial officer, he or she is going to hire their controller, their assistant controller, their accounts payable clerk, their cost accountant, right? It just goes on and on down the list. Jumping all the way back up to here, right? The way that when you become a stockholder, they're going to issue you a share of the company, right? And that share represents ownership, right? If there were 100 shares available and you owned one share, you'd own 1% of the company. If there are 100 shares available and you owned 30 shares, that means you would own 30% of the company. What questions do you have? Are you doing all right? So when a company first starts, right, the first thing they need money, right? It takes money to make money. So regardless of what or company you're going to start, you're going to need some capital, right? And there's two ways that a company can get that money. They can go and borrow it. You can go to a bank. Small business, you can take out a loan on your credit card, right, which is, again, borrowing money in order to start the business. Or you can say, I've got this idea. Who believes in me? I'm willing to sell shares of my company, right, to people in exchange for money. So what's an advantage? Each one of these has its pros and cons. What's the advantage of borrowing money to start a company?
You are the sole owner?
Mm-hmm.
Yeah, no,
You're good. Go ahead.
Yeah, you have like ultimate control in the company, and therefore when your company does kind of boom, you kind of take responsibility of all that, and you can gain all the net profit from it instead of dividing it up amongst your shareholders. Like if you were to have a shark invest in you and have like 25 or 50% of the company, that's kind of taking a big hit long term, of the amount of money that you could have received but then again, it wouldn't be as big if you didn't go to them, you know what I mean? So
Yeah. What are the disadvantages? That's spot on. Very well said, Evan and Andrew. What are some of the disadvantages to borrowing money to start a company?
In case your cash flow was short for like a period of time, you'll still struggle with like monthly payments.
yeah, you're kind of digging yourself in a big hole kind of right off the bat. Much like you would, I don't know, student loans are kind of the same way. Like you're basically jumping down into a 6 feet hole that you kind of have to work your way out of, and that you hope to work your way out of over time.
Mm-hmm. What are some advantages to selling ownership in your company, financing your company through issuing shares?
Rapid growth.
Tell me more.
Let's say for like another Shark Tank example, you have, let's say, Mark Cuban invest in your company. You're going to see a very steep exponential growth. Say you start slow and then it just kind of ramps up because he's able to kind of construct your business, and able to like really get the ball rolling a lot faster than you would have been from being the sole entrepreneur. You now have an elite entrepreneur as your partner, helping you, kind of guiding you and telling you what to do, allowing that process to speed up a lot faster.
Right. You're talking about selling to the right person.
Yes.
That has that influence.
Mm-hmm.
Yep. What are some other advantages of selling ownership instead of borrowing the money?
Less debt for yourself if you're going to be borrowing money instead of that.
Yeah, less debt. So one of the advantages is if this business doesn't work out, you don't owe anybody anything. Right? Remember, we were in this together. We were all owners, and we thought we had a plan that was going to work. It didn't work. So I'm going to go back to working at Burger King, and you can go back to your $1 million home and just call it quits. Right? What are the disadvantages to selling ownership in your company?
They make some decisions for you, or they stop certain things that you want to do just because they don't like it.
Yep, very well said. Right. So ownership means control, right? And so if I'm selling you 30 of my 100 shares, well, then now you have 30% control, 30% say so in what this company is going to do, right? And so if you've got this idea, this vision that you want to run without Mark Cuban's involvement or anyone else's involvement, then you do have to be mindful of, do I want to sell ownership, or would I rather just borrow money from Mark Cuban and agree to pay it back?
Yeah, it kind of goes back to the equity method where like that person has now significant influence in your company. And so you kind of have to run everything by your partner before things get done. And if there's disagreement, then that's where problems can start to happen.
You are very right. So we're going to do a hypothetical scenario. I'm going to start a company, and I think you all know what type of company I want to start. That's right.
Star Wars?
I'm going to start a used marker business.
Yo, I haven't heard
That
that.
has been so successful for me. All right. So when I start this used market business, and I'm deciding that I'm going to, instead of take on debt, I'm going to sell ownership in the company. I'm actually going to sell some ownership to some of you all on this call today. So here's what we're going to go over today is 4 different types of shares. Okay. Stock. We're going to talk about authorized stock, issued stock, outstanding stock, and treasury stock. So stock and shares are synonymous. And so we're going to talk about authorized stock, issued stock, outstanding stock, and treasury stock. Okay. So let's start with authorized stock. So authorized stock or authorized shares, this is going to establish the total number of shares that a company is authorized to issue. So when a company wants to start, when a company says, hey, I want to incorporate, okay, they have to complete a company charter, okay? And that company charter is going to lay out, these are the total number of shares that I can sell to shareholders, okay? For that simple example, I would
that
say,
number?
I'm sorry?
Who determines like the authorized number? Like, is it the owner of the company, or is it you, or is it someone else?
It's the person that's starting the company. So that would be the owner or owners.
So do they just like figure out that number in terms of like what they like, the amount of money that they need in order to kind of take that company to the next step, or like how do they determine, oh, we're going to give this many shares away at this price?
So if I were to start a company and I said I'm going to authorize 100 shares, right? What's the total number of shareholders I can have?
100.
100, right? Or 99, because I think I want to own some as well, right? But I don't want to own more than 1%. So if I want to own 51%, then the total number of shareholders I can have is 49. Now, what if I said I want to authorize 1 million shares? Okay. How many shareholders could I have?
1 million.
Yeah, I can have up to 1 million shareholders, right? But if I want to own 50%, right, I could still have up to 500,000 shareholders. So that is playing into what that number is going to be, right? And if you're going to be a publicly traded company, you want there to be access, ability to purchase shares in your company. I could go back. So I want to see. How many shares Apple has. So if you look here, okay, Apple has authorized, and I think these numbers are in, yeah, number of shares are reflected in thousands. So Apple has authorized 12,600,000,000 shares. So you can always see the total number of authorized shares on the, I shouldn't say always. Generally, companies will show the total number of authorized shares on the balance sheet, okay, in this area under capital. The other thing that you're going to find in the company's charter is, use market business, is the par value. So this is a bit of an archaic approach, but it's still the approach that's being used. Okay? So companies have to establish a nominal value. Okay? This is the minimum amount that we will sell a share of our stock at, one share of our company. So that's what the par value represents, the minimum value that they charge. Okay? Par value and market value have no relation to each other. You have to establish the minimum value. What do you think Apple's par value is for one share, minimum value that they will sell you a share at?
The share price, so like right now, like 280.
$280. Let's type them in the chat. What your guess is?
Well, why would they give you a discount?
$15. The minimum amount that Apple can legally sell you one share. I'm seeing a penny. Okay, went from 15 to a penny. I'll tell you this, 15 is too high. I'll tell you this, a penny is too high.
It's like $0.00000001. Like fraction of a cent.
Who's looking at
it was a fraction
Apple's?
of a cent.
So it's right here. Apple's par value is like I don't even know how to do that type of fraction, but less than 1 penny, much less than 1 penny. I did the math. You would have to own 100,000 shares of Apple to equal $1. I don't own 100,000 shares of Apple, unfortunately.
Yeah, it is 100,000.
So this par value is really important in accounting, but it's meaningless everywhere else. It's really important in accounting. It depends on which state the company is incorporating in. Okay? Some states offer or allow you to do no par value stock. Okay? But most companies are incorporated in one state. Here's another question for you. Type it in the chat. What state do you think most companies are incorporated?
Delaware.
Okay, I'm seeing Delaware. Other guesses? How come I'm not getting that same excitement when we're playing Kahoot? There was just so much fire. New York. All right, Delaware. All right, you all are too smart. It's Delaware. Has anyone ever been to Delaware? Never been to Delaware.
I've been to the airport.
You have?
Yeah. Just in the airport.
Sorry to hear that. So I don't know what Delaware is famous for other than all the corporations are incorporated there. And I just imagine there's like this huge mailboxes, etc., that has thousands and thousands of PO boxes for Apple and Google and Microsoft and whoever else is incorporated in Delaware, because I don't imagine that they have actual offices there.
Why Delaware though?
Apparently, Delaware has very favorable state laws to corporations. So that's where they choose to incorporate. California and Nevada are two examples of states that have no par value. What you're also going to see on this charter, right, is it's also going to tell you here are the rights, right? So there's kind of two classes of stockholders. There are common stockholders and there are preferred stockholders. And each one of those will have specific rights. For example, there could be voting rights. If you're a common shareholder, you get to vote. So you get to vote for who's going to be on the board of directors. If you're a preferred shareholder, you may not have the right to vote. Dividends. Dividends, we all know, or maybe we don't. Dividends are money that's paid out to the owners, to the shareholders. Okay? And if you're a preferred shareholder, you may have what's called cumulative dividend rights, which means every year you're entitled to receive some money, whether they make a profit or not. They have to pay you out some money. For common shareholders, usually you do not have a right to dividends. You only get dividends if the board of directors votes to pay out dividends. Liquidation preferences, generally speaking. So let me just pause. Every charter is going to set it up differently, right? So I'm just giving you some general ideas of kind of the differences. If you're a preferred shareholder, if the company were to close down, go out of business, right? They'd say, okay, we're going to go out of business. We're going to take all our assets, pay off all our liabilities, and what's going to be left is our assets are just going to equal our equity. And then we're going to take that equity and distribute it out to all of our shareholders. Well, preferred shareholders would have liquidation preferences. In other words, we're going to pay the preferred shareholders first, and then you common folk are going to split whatever is left over. And then there's something called preemptive rights. So a preemptive right, usually reserved for preferred shareholders, helps preferred shareholders maintain their ownership percentage. So think of it this way. If I owned 30% of the company and then they decide, hey, let's sell some more shares to this new investor, I have the preemptive right to say, well, wait a second. If you sell more shares, my ownership percentage is going to go down. So I have the right to now purchase additional shares in order to maintain my same level of ownership. Questions?
So preemption, wait, that allows people to just buy more stock? What?
Yeah, it allows shareholders to, whenever they're selling more shares to a new investor, it allows that shareholder to maintain their same level of ownership percentage. Other questions? All right, so let's look at this use marker business. Okay. So let's say I decided to turn this into a corporation because it was so successful in Chapter 6. And I'm going to write this down. You all should write this down too. I'm going to authorize 275,000 common shares. Okay. and I'm going to establish a par value of 1 penny each per share. Okay. I'm also going to establish 125,000 preferred shares, and those will have a par value of 1 penny. Okay. So my total authorized shares is 400,000. Okay, 275 plus the 125, 400,000 shares. So that means the total number of shares that I can sell to shareholders would be 400,000. And let me go back to the chat room because I thought I saw a question in the chat room. Yeah, so Jasmine said, if a company does a secondary offering, are those shares considered authorized? The answer is yes. So you can always go back and authorize additional shares.
Can you change the type of stocks you issue? Like it goes from authorized to like a different thing, or is it kind of like set in stone?
Don't know the answer to that specifically.
Mm-hmm.
What I would suggest is that in your charter, you would create features that would allow for common shares to be turned into preferred shares and preferred shares to be turned into common shares.
Mm-hmm. Okay.
So that you don't box yourself into a corner. That's more of a legal question.
Okay.
We'd have to get Dr. Coleman on the line to answer that for us.
The charter only pertains to stocks. It's separate than like the bylaws, for example, because bylaws is kind of legal things.
The bylaws, sorry, the bylaws are included in that charter. So the charter is the bylaws. I think what's also included in addition to the bylaws are how many shares are going to be authorized, what's going to be the par value of those shares, what type of rights will those shares have, shareholders have. All right, so now let's talk about, that's authorized shares. We're going to talk about issued shares. Okay. So the number of shares, so when we say issued shares, what we're referring to is the number of shares that have been sold or given to stockholders. If you close your eyes and go all the way back to when we were in the classroom, we were working on chapter 2, and we were first learning journal entries, and you're like, what? What's a transaction? Right? One of the first transactions we did is we said the company issued common stock in exchange for $40,000 in cash. Okay. That would be an example of issuing shares. So a company can issue shares in exchange for cash. They can issue shares in exchange for equipment. Okay. We were talking on, I think it was yesterday or Tuesday, about convertible debt. They can issue shares in exchange for debt. Say, instead of us paying you this money, we're going to give you shares. They can issue shares in exchange for goods or services. Okay. So instead of saying, I'm going to, instead of saying, I'll pay you for this inventory, how about you give me this inventory and I'll give you some ownership in my company instead. Okay. And they can also exchange shares for compensation. You may be aware of the famous story. Steve Jobs' annual salary was $1 when he was a CEO of Apple.
Yeah, because he just pays. He just sells some shares, right? He just sells his shares so that way he doesn't get taxed on it as much. Is that true?
Yes. So that's very true. That's exactly what was happening. So instead of him saying, pay me in cash, he said, pay me in shares, right? And then he was able to take those shares, right? And those shares were valued at, the millions of dollars, and then sell those shares, right, to the public in order to live off of. Here's the other piece, right? So, that he earned, right, gets taxed at its normal tax rate, which for him, his effective tax rate would have been somewhere in like the 30%, right? So that's 30% of that dollar that he has to pay. But when he was selling shares, if he was selling them after owning them for a year, it's considered a long-term capital gain. So he's only paying 10% in taxes on that. Just another way that the rich get richer.
It's legal tax diversion, essentially.
Yeah, there's a lot of legal things.
One of the downsides to corporations, though, don't they do like double taxation or something along those lines?
The individual, right? So if I own the company, then the company is going to have to pay taxes, and then whatever I get paid in compensation, I have to pay taxes on that as well.
Okay.
I think that's what that means, double taxation. Regardless of how we issue shares, whenever we issue shares, we're going to increase our equity for the fair value of the asset that's being received. So if we're exchanging or issuing common stock in exchange for $40,000 in cash, what's the fair value of $40,000 in cash? Can I get my calculator? How much is $40,000 worth? Oh yeah, 40. I didn't need this. $40,000, right? It's the fair value, what it's worth. But let's say that Eric Bell agrees to do 50 hours of work in exchange for common stock. What's Eric Bell's worth for 50 hours? Right. So now there's a bit of, wait a second.
It's like that's
how much is that
exponential revenue just from 50 hours of work, right?
Well, we're looking at it from the company's perspective, but yeah. So that's how we have to figure out the fair value. And here's where this par value comes in. Okay, when we're increasing our equity, so right, whatever we receive, cash, debit cash, 40,000, whatever we received, we only increase common stock for the par value times the number of shares. Anything paid in excess of par goes into this account called additional paid in capital. Right here, additional paid in capital. So let's do an example. Let's say that a company is selling 600,000 shares of common stock. Better write this down. 600,000 shares, common stock, at $10 each. And the par value is $1 per share. 600,000 shares of common stock, $10 each, and the par value is $1 a share. So if we were to go to so we have the date, whatever the date is, and we received cash equal to 600,000 times $10, right? We sold 600,000 shares at $10 each. That's 600. We're going to credit common stock. We're going to credit common stock for 600,000 shares that we sold times $1, the par value. Okay, this is the 600,000 shares at par value of $1. And the difference, because our debits have to equal our credits, is going to an account called additional paid in capital. Okay. So that is the difference between this number minus this number, 5,400. Both of these are part of capital, right? So assets equals capital plus revenue minus expenses minus dividends. These are both considered capital. What questions do you have? Let's get back to this used market business. Okay. Decided I think I authorized 400,000 shares, and I told you I'm going to sell some shares to some of you all on this call. But before I do that, right, I think I should first sell some shares to myself, to me, because yeah, I want to make sure I retain control over this. Okay, so I'm going to exchange cash, some inventory, some equipment, okay, that has a combined fair value of $200,000, and I'm going to exchange it for 125,000 common shares and 25,000 preferred shares. Okay. So I were to go back to our journal entry template, what that would look like. Okay. So on this date, I don't even know what day it is. Today's what, the 16th maybe? So I would have cash, I have inventory, and I have equipment, okay, and the sum of all that equals 200,000. Okay. And I'd have to divide it up between the three, but I'm not going to do that right now. Let's say it was $10,000. Just do a round. Get $10,000 in cash, $50,000 in inventory, and $140,000 in equipment. Okay. In exchange, I got common stock, which would be equal to 125,000 times 1 penny, right? That's 125,000 shares at par value of penny.
Would that be Wouldn't that be $125,000, not $1,250?
Look at my math. That'd be 100. That'd be that 125,000
Times a penny.
Times a penny.
Okay, I see what's.
Yeah. And then I also gave myself 25,000 shares, preferred shares at a penny. And then the difference, because I need this all to equal, I need my debits to equal my credits, would be the difference between this plus this plus this minus this minus this. 198,500. This is the difference between the fair value of the assets received and the par value. What questions do you have? So at this point, how many shares are authorized? How many shares are issued?
Figure out how
In the
many
chat.
that you originally offered.
Chat. Yep. How many shares are authorized? How many shares are issued? Man, I hate that this is being recorded because I've got zero. Oh, there we go. I got some participation. I see 150,000 authorized, 600,000 issued, 400,000 authorized. So actually, at this point, I have 400,000 shares authorized, right? That's what I said I would do, 400,000. And 105,000 shares are issued to me. Questions?
How'd you get 400,000 shares?
So if we go,
Are we going off that previous example that you did with the 600,000 shares?
no. Throw it back here. connecting. All right, we're back. You're here. And so of the 400,000 shares that my company can issue, I've issued dry market business, 125,000 common and 25,000 preferred to me. So now that I have the ownership in the company, let's issue some more shares. So I'm going to sell 50,000 shares at $10. Sell that. Am I frozen again?
Yeah, there we go.
All right. So you can see that 50,000
Yeah.
common shares at $10 a share. I go back here. Can you see the spreadsheet?
Yeah.
So Hadrian's going to pay me cash equal to 50,000 shares times $10 a share. Okay. This is the 50,000 shares at $10 a share. In exchange, you got common stock. And I record it at 50,000 times the par value of a penny. And the difference goes to additional, there we go. Paid in capital, which is just the difference between this and this. Questions? So at this point, how many shares are authorized?
Still 400,000, right?
Still 400,000. Yes. How many shares are issued?
175.
Isn't it 200,000 because of the 25,000 preferred stock?
200,000.
I forgot.
25 plus 25 plus 50. 200,000. If Hadrian and I were to have a board meeting and we had a vote as to which colors of used markers we should sell, and God forbid Hadrian and I had a disagreement, who would win that?
You?
I own 75% of the company. But I respect Hadrian's opinion and everything, but I do own 75% of the company. So I would ask Hadrian, I say, Hadrian, let's sell some more, let's issue some more shares. And Hadrian, do you agree? You get a vote in this. Is Hadrian going to come to the chat? You want to sell some more shares, Hadrian? Issue some more shares? We're all waiting for your
Would you
vote.
mind going back to the spreadsheet real fast?
Hadrian says yes. I'll go back to the spreadsheet in 1 second because we're going to be back there. Because Hadrian said yes, just issue more shares. I agree to issue more shares. So let's issue some more shares. So now we're going to exchange $25,000 in preferred shares, not for money, but for consulting services. Okay, so we hired the firm of, who do we hire? Oh, the anticipation. Oh, the firm of Tatiana. So Tatiana agreed to give us $375,000 worth of consulting fees in exchange for 25,000 preferred shares. What that means is the fair value of my preferred shares, is $375,000, right? Because otherwise, Tatiana would not have agreed to this. So I go back to the spreadsheet. Down here now, I would debit consulting expense, $375,000. That's what I received. I would credit preferred stock, which is going to be equal to 25,000 shares times the par value of a penny. Okay, that's 25,000 shares at par value of a penny. And my other credit would go to, you guessed it, additional paid in capital. So I'll pause here and let you catch up, let you ask questions.
So does this mean you still have 400,000 shares authorized, and now you have, hold on, wait a second. Yeah, and now you have 225,000 shares issued?
Yes. That is exactly what that means.
Mr. Bell, were we given the 400,000 in your example, or is that something we calculated?
It was way back in when we were doing the authorized stock, like the first example. He gave us an example of authorized 275,000 common shares at 1 cent par value, and then 125,000 preferred shares at 1 cent par value. So that means our total authorized shares is 400,000.
Okay, just the 275 plus the 125?
Yeah.
Okay.
Great. Other questions?
Yeah, Mr. Bell, when we were doing this is way back when we were doing like marketable and trading securities, was that from our perspective? And now we're doing like a corporation perspective. Or are those just
Everyone being at home.
Yeah, I think this is exposing issues with my Wi-Fi. It seems to work great at like 10 o'clock at night when I'm binge watching Netflix, but you know, that's neither here nor there.
Mr. Bell,
All right.
why do we
Yeah.
why is the additional paid in capital even an account that's utilized? That seems kind of overly complicated, right? Why do they use that?
I'm going to answer your second question. Yes. Your second question was, it seems overly complicated.
Yep.
Yes.
Yep.
First question, why?
It's just what they do. All right.
What it is, man. Unless you're in California or Nevada, no par state, well then you don't have to deal with the additional paid capital. But you're getting the sense this additional paid capital is a useless account. And if we were to look back at Apple's common stock separately, would be useless information. All right, let's issue some more shares. I got to get votes from my fellow investors. Hadrian, Tatiana, you guys okay with issuing some more shares? Doesn't matter. I own more shares than you guys. Oh yes, of course, it does matter, Hadrian. Of course, you count in this decision. Tatiana, would you like to issue your vote as well? We're gonna win. I said yes. So we'll issue some more shares. We're gonna sell 50,000 common shares at $20 a share. So thanks to Tatiana's amazing work, now the value of our company is worth more. And let's see here. So who are we going to sell these shares to? Oh, to Kendall. Congratulations, Kendall. You are now part of this great company. And we sold 50,000 shares at $20 a share. Let's go back to our spreadsheet and see what that journal entry would be.
Did Tatiana's consulting business raise the company's value, or just her being a part of the company?
I think it was her consulting work. She told us to do things a little differently than we did. So we got cash, and it was 50,000 shares at $20 a share. That's $1 million. Kendall's balling. Common stock, as Bradley pointed out, this part really doesn't make a whole lot of sense, but we're going to take 50,000 at a penny, okay, and then the difference goes to additional paid-in capital. Okay. Just a difference between this $1 million and this measly $500.
It's kind of useless, but it keeps up with the trend of adding useless accounts.
Okay. How many shares are authorized now?
I think it's 275,000.
Authorized is, I heard it, 400.
Oh yeah, 400.
How many shares are issued?
275.
275. If there was to be a vote on something, who would win that vote?
You?
I will. I own
On an individual.
100,000 shares.
So I just have
Okay,
a
let's
quick
take another-
question. For
Yeah.
the common stock, are we always going to multiply it, the amount that you sold, by the par value?
Yes, and the preferred stock.
Okay.
I'm sorry, we have to vote. Kendall, Tatiana, Adrian, would you like to issue more shares? My vote is yes. Kendall says yeah. Adrian says yeah. I don't think Tatiana comes to our meeting, or she gets there late. I don't know, she's making a ton of money in consulting. Oh, she says yes. Okay, I vote yes. So let's issue some more shares. We're going to sell 25,000 preferred shares at $40 a share to this guy, Deontay. All right, so we're going to sell 25,000 shares at $40 a share. Let's put that into our journal entry. So Deontay is really balling because he bought 25,000 shares at $40 a share. Wait, did I do that right? Oh, I mean, I guess it did. And then this is going to be equal to 25,000 times a penny. So yes, Madison, oh, that's a preferred stock. It's always multiplied by the par value. And in this case, the par value is a penny for both, but it doesn't have to be a penny for both. It can be separate. And then the difference goes to additional paid-in capital, which is this minus this.
Why is it $1 million that you received in cash when it's $40? Oh, wait, it's
Yeah, 25. I had the same question, but I trusted the spreadsheet. So now, how many shares are authorized?
400,000.
400. How many shares are issued?
300,000.
300,000. If there was a vote and there was a disagreement, who would win?
You?
I own 150,000 shares.
Not team up on. I think they can team up and match you at this point, though.
They could, right? So I don't want to issue no more shares because this is my use marker idea. Okay, so and Deontay doesn't want to issue any more shares, right, Deontay?
No.
Okay, so we don't have to take a vote because it doesn't matter what everyone else says. All right. So that's issued shares. Okay. I think I talked about this. Some preferred shares have convertible features, right? So they can take preferred shares and say, instead of you being an owner, we can convert it into a common stock, right? So, or we can convert it into debt, right? So every company has their own different type of convertible features. That's all I want to say about that. Let's talk about outstanding shares. Okay. Now, stick with me on this one before you start writing. Outstanding shares are the number of shares that are actually held by a shareholder. So there could be shares that are issued, but they're not currently held by a shareholder. That is what we're going to talk about next, which is called treasury shares. Okay. But if we don't have any treasury shares, then our issued shares equals our outstanding shares.
Can you go back to the slide where it said preferred shares? Or is there?
Oh, it was just a picture.
Oh, okay.
It was just a picture of a car.
Okay.
Yeah.
so our preferred shares something we're going to learn in the intermediate accounting classes. Okay.
Yes. So this outstanding share is really the most important number. Okay, and here's why. Two things. One, when we're looking to pay dividends, we're paying out dividends to so only those shares that are held by shareholders. Okay? The outstanding shares, those are the only ones that will receive dividends. It's very important. The other thing is we're using the number of outstanding shares to calculate this ratio called the earnings per share. And Jassim appears to be very much in tune with the stock market. So I'm sure he's heard of this term before, EPS, earnings per share. Okay. It is a really important number that's used by investors to determine the value or success of a company. Okay. This is the most, in my opinion, the most important financial statement ratio. And here's why I say that with so much confidence. It is the only ratio that actually appears on the face of the financial statements. When you look at the income statement, which we'll do in a couple of weeks, you'll see that they list out the company's earning per share. And that earnings per share is based off of how much net income did you generate divided by the number of standing shares. I'll let you all ask questions.
Right, so what's the treasury shared? What's what's specific about that?
Well, we haven't talked about that yet.
Okay.
Yeah, earnings per share is just like the average money amount per share that each shareholder is getting for that quarter, correct? And so like a good EPS ratio is around like 14, right? Something like that.
No, not something like that, but there's no good EPS ratio. I think you're thinking of the
Price to earning. I'm thinking of the price to earnings ratio.
price to
Yeah.
earnings. That's what I was, price to earnings ratio. EPS, it's a what if scenario. What if we divided all of our net income and just gave it to all of our shareholders? How much would each shareholder get for every share that they held? That's what that number is. So let's think about this used market business. All right, we've got how many shares authorized do we have right now?
400,000.
400,000. How many shares issued do we have right now?
300,000.
300,000. How many shares do we have outstanding right now?
Would it be 100,000?
300,000 because they're in people's hands.
300,000 because they're in people's hands. There's me. I own 150,000 shares. Adrian owns 50,000. Tatiana owns 25. Kendall owns 50,000, and Deontay owns 25,000. We're all individuals holding shares in this lucrative used market business. Let's talk about treasury shares, because I think that'll bring it all together. Okay. So treasury shares is when a company repurchases their own shares. Don't worry about writing all of these things down because they're in your book. But these are just some reasons why a company, and we kind of talked about this earlier in the class, reasons why a company would want to repurchase their shares. And I teased this out on Tuesday that treasury shares is what's considered a contra equity account, which means it sits with the equity accounts, but it acts contrary or opposite of the equity account. So we normally increase an equity account with a click, right? I don't know how you're looking at me, but but for oh, it just cut me off. All right, and it's back. All right, so I would like to, let's go back to used market business. I would like to repurchase some shares from shareholders. Because truthfully speaking, I don't like not being able to have control of the company. But I'll give you a more sophisticated reason. I think it's good business, blah, 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 blah. So let's take a vote. Adrian, Tatiana, Kendall, Deontay, do you think a company should repurchase shares? My vote is yes.
Yes.
The others say. Oh, good. Oh, good, good, good.
Yes.
All right. All right. We are going to repurchase 50,000 shares at $26 a share. And we're actually going to repurchase them from, this is her decision, Kendall. Kendall made out like a bandit. So Kendall says, that's cool. You can sell my shares. So let's look at what this looks like when we repurchase 50,000 common shares at $26 a share. So we're going to debit treasury stock and we're repurchasing it. So we're going to credit cash. We're going to credit cash for 50,000 shares at $26 a share. So we paid Kendall $1.3 million and got 50,000 shares at $26 equals 50,000 shares times 26.
I'm sorry, just really quick for the contra equity account, how would you increase it and decrease it again?
Contra equity accounts increase with a debit.
Okay, thank you.
You're welcome. It's the opposite of equity.
Wait, is it retained earnings or not?
It is not. It's still part of capital, still a capital account. Okay. It's a contra equity account.
So why is treasury stock not sold at par?
Anytime, well, one, because par is a meaningless number. And two, because we have to negotiate with Kendall what she's willing to sell it for. We wanted to sell it to her. We wanted to buy it back from her at $20. And she said no. And so we said 21. And she said 35. And then we agreed on 26. So it's a market will bear.
So, for example, if the par value is 1 cent, let's say you held something over Kendall, you could bring her down to 1 cent.
No, because what Kendall can do is she could always take her shares, assuming there's nothing in the bylaws that prohibits this, and sell it to you. Right? Kendall owns those shares. She can sell them to whoever she wants to.
Mm.
And if you're willing to pay $26 for it, then that's what we have.
Bylaws can restrict who they can sell it to?
Absolutely.
Oh, damn. I didn't know they had that power. Or anyone had that power.
And yeah, and actually I'm thinking about that more. I apologize, I answered that question too quickly. This is a contra equity account. And Jasmine, it is part of retained earnings. It's not part of capital, it's part of retained earnings. So at this point, how many shares are authorized?
400.
400. How many shares are issued?
Still 300,000, right?
250,000.
Still 300,000, right? That's what we've issued out as 300,000. But the amount that's outstanding is how many?
250.
250. Just me, Adrian, Tatiana, and Deontay.
So those 50,000, are they just like floating out there, or do they come back to the majority shareholder?
No, they're owned by. They're not owned by me. They're owned by the company. So the company is holding these shares.
Okay.
So from these examples, there's 250,000 outstanding shares left then?
Yes.
Okay.
So if we were to pay dividends, right, the company can't receive dividends from itself, right? So it's only going to receive dividends. It's only going to pay dividends out to the shareholders, me, Hadrian, Tatiana, Deontay. Now, what a company can do is they can hold the shares, they can retire the shares, or they can sell the shares. So, business is booming for the used market business. I would like to vote to sell some of our treasury shares. So let's hear from my our investors. Hadrian gonna vote, and Tatiana's gonna vote, and Kendall's gonna vote.
Wait, so we currently have 50,000 treasury
And-
shares.
Yes. I vote yes, so I guess it really doesn't matter what other people say. Oh, but of course it matters. I mean, we're all a team. All right. And Kendall, you're not a shareholder anymore. You don't get to vote. Get out of our meeting. You're rich now. You made all this money off us. All right. Whoa. Or is that a woo hoo hoo? I don't know if that's a whoa or if that's a woo. Like, yay, I don't have to vote. All right. We're going to sell 25,000 common shares at $28 a share. Okay, and let's sell them to, who is this? Madison. All right, we're selling 25,000 common shares at $28 a share. All right, so this is where it gets serious, y'all. 25,000 shares at $28 a share. So when we sell treasury stock, well, let me do the easy part first. Cash, we got cash of $28 a share. Was it 28?
Yes.
Okay, thank you. $28, and we sold 25,000 shares. So we got cash of 700,000. Now watch this. When we sell treasury stock, we sell it at the same amount that we bought it for. So we bought the shares at $26, so we're going to sell them at $26.
And then is the difference just the paid and additional paid in capital account?
Yes. So our difference is going to be the difference for our debits and our credits will go to additional paid in capital. Let that sit for a second and see what questions you have.
Yeah. So because the additional paid in capital is like a useless account, we really we're getting the 700,000. We're just allocating 50,000 of it for no reason.
Yeah, kind of.
Okay. Yeah. I see so we got buy for 650 in the last example, I guess is my question.
Say that again.
When we bought it from her, 650,000 was our number, because I didn't write that down.
$26 was our number.
Oh yeah. Okay.
We repurchased 50,000 shares from Kendall at $26 a share, and we so when we sell those same shares, we have to sell them at the same price that we bought them at. The point here is this: you can't have a gain or loss from selling your own shares. So that's why we're using this additional paid-in capital account.
Mr. Bell, I have a question.
Yes.
So hypothetically, if let's say the company bought some shares at like prior to buying it back here at, let's say, like $24, and they had like 10,000 shares,
Mhm.
can you apply LIFO and FIFO just like you would with inventory?
I don't think so. I don't
But
think
there
so.
would be two different values for the purchase price of the stock buybacks, right?
Yeah, they would come in at different values. And I'm not going to even guess. I'm going to look the answer up, and then I'm going to reply to you later.
Okay.
Yeah, I don't even want to guess what the correct answer is. But it's not LIFO or FIFO.
Okay, because like
In the
chances are that let's say for all the treasury stock for a company, it's never going to all be at the same price, right? Because they buy them back periodically.
Correct. So they're either going to have to take the first one, do it in that like a FIFO order, or they're taking a weighted average, or they're picking and choosing, right? They have to pick one of those two. So it has some similarities, but we don't call it LIFO, FIFO, weighted average.
Okay.
All right. So how many shares are authorized now?
400,000.
400,000. Not changing. How many shares are issued?
275. 300,000. Back to
300,000. How many shares are outstanding?
275.
275. I've got 150. Hey, 50,000. Tiana's got 25. Deontay's got 25, and now Madison has 25. So let's do one more vote to sell some more treasury shares. My vote is yes. Let's see what my board of directors say. Tatiana says yes. No one else is going to vote. I guess they realize it doesn't matter. Oh, Hadrian says yes. Madison's saying yes. All right. Alex. Who let Alex into our meeting? Just for the board members.
Mr.
All right, but Alex said yes. All right. So let's sell 25,000 shares at, $16 a share. It's like we're in the coronavirus. Prices have dropped. And who likes to buy during the dip? Jason. So I want you guys to see what happens here. Okay? We're selling 25,000 shares at $16 a share. So when that happens, we're going to get cash equal to 25,000 at $16 a share. 400,000. We still have to reduce our treasury stock at the price we paid for it. Okay. So we bought these 25,000 shares from Kindle at $26 a share. Oh. So that's what we have to record. That's what we have to credit our treasury stock for. This leaves us with a difference of $250,000. And where do you think we should debit this $250,000?
Additional paid capital.
Additional paid in capital. Because we don't take losses, we don't record gains from selling our own treasury stock. Questions?
So we would debit the additional paid in capital if the price of the share decreases.
If the amount that we're selling it for is less than what we purchased it for, right? This is 25,000 shares sold at 16.
Yeah.
Then yes, that would result in a debit to our additional paid in capital. Other questions? And so at this point, now we're back to 400,000 shares authorized, 300,000 shares issued, and 300,000 shares outstanding, because we don't have any treasury stock anymore. So one last thing I want to go over is dividends. Okay? And we all know dividends is another kind of like a contra equity account, right? It reduces our retained earnings. But what I want to focus on are three important dates. Okay. First one is called the declaration date. This is the date when the board approves dividend. Okay. So as a board of directors, they meet and say, let's agree to pay dividends out. Okay. And they're going to agree to whatever, 7 cents a share, 25 cents a share, whatever dividend amount they want to. It's on that date that we have to record a journal entry. On the declaration date, we record the dividend and we record a liability, because at this point, now the company owes the shareholders something. The next date that's important is what's called the record date. There's no journal entry on this date, but this is extremely important because this is when we go through our log and say who owns shares of this company, because that's who we're going to pay. And then the third date is the actual payment date. And it's on this date that we credit cash, because we're actually making a payment, and our debit is to reduce the liability that we have recorded. What's important to know here is once we get past the record date, okay, let's say there's a difference of a week between the record date and the payment date. Whoever's on record of getting paid this day, they're the ones that are going to get paid. So real quick with our drive marker.
I just have a quick question.
If the board.
For the date,
Yes.
What gets recorded, what counts?
It would be. It would be a debit to the liability and a credit to cash.
Okay, thank you.
So someone who, sorry, I'm so sorry, but someone who buys a share after the record date will not be getting paid dividends.
That's right.
Okay.
That's right. So when the board, let's say the board approves dividend, I'm sure one person would agree with me, 4 cents for common shares, 8 cents for preferred share. That means every common share that you own, you're going to get 4 cents. And every preferred share that you own, you're going to get 8 cents. Okay. So if I do the math, that would work out to be $15,000. So Madison and all, that journal entry on the date of declaration would be a debit to dividends, right? Your equity account equal to 15,000. Okay. And because we didn't pay anything, we credit dividends payable of 15,000. Because once the board approves it, then it becomes a liability.
Where'd you get the 15,000 from again? Just really quick.
That would be, I'll show you on this next slide.
Okay.
And that was an example of the declaration
You're
date
sorry,
right there?
That was the declaration date, yes. So on the date that we figure out who gets paid, right, I'm going around and I'm looking to see who owns shares. Okay. So Jassim owns 25,000 shares, so he would get $1,000. 25,000 times 4 cents. Madison owns 25,000 shares, her common shares, so she'd get 1,000. Deontay owns 25,000 shares, which are preferred, so he get 2,000, right? 25,000 is 8 cents. Tatiana owns 25,000 shares at 8 cents. Hadrian, my number one investor, owns 50,000 shares at 4 cents, so we get 2,000. And then me, I get 7,000 because I had 125,000 common shares, 25,000 preferred. So Madison, the sum of all these things, how we got to 15,000.
Thank you.
You're welcome. And at this point, there's no journal entry to be made. But we're just figuring out who's going to get paid the 15,000. Right? And now at this point, Hadrian can say, hey, I'm out. And Hadrian can decide to sell all of his shares to Bradley. Right? Even if he does that, Hadrian's still going to get his $2,000 in dividends because he was the owner of those shares on the record date. And the last thing is we pay the 15,000, which would look like this. Debit dividends payable for 15,000 and a credit to cash for 15,000. What questions do you have? That is equity, y'all. I apologize for going over. Next week, next Thursday, is going to be another exam, which will be administered online. So we'll get together on Tuesday and go through the quizzes and answer any questions you have. It's going to be on chapter 7, 8, 9, and 10, and a bit of Appendix E. What I will do over the weekend is I'm going to open up some practice problems that you can do for to prepare for the midterm. And not homework, but just things that you can do. I encourage you to, at least before Tuesday, open it up and look at those questions so that you can come to the session with some ideas about questions that you have. All right, everyone, have a great weekend.